So welcome everyone to the earnings call for Max India. It's my privilege to introduce my colleagues who are joining me on this call. Some of them are in person, some on the phone. So Mr. Rajat Mehta is Managing Director for Max Healthcare. Mr. Yogesh Sareen is the CFO for Max Healthcare. They're here in person with me. Rahul Ahuja is the CFO for Max Bupa, and he's on call. And I'm joined by Jatin Khanna, who's the CFO for Max India. I won't spend too much time in terms of the numbers because I really want my colleagues to talk about those in more detail. So I'll restrict my comments at a pretty high level. So just as a brief overview, Max Healthcare had a modest revenue growth of 7%. They achieved 2,619 crores, and this modest growth was as a result of some of the regulatory headwinds which the sector is witnessing, and more details we'll talk about later. And most of you may be aware that late last year we had an unfortunate incident in one of our large hospitals here in Delhi, the Shalimar Bagh facility. So a combination of this has really impacted the growth, which was, for the first 2 quarters it was moving in a very satisfactory direction. But unfortunately, we got impacted with one of the regulatory headwinds, which all hospitals, in this jurisdiction have been impacted. But we had this one-off event, and so I'm happy to say that this is behind us. And so to minimize the risk of reoccurrence of such incidents and to adjust for regulatory actions, we decided to recalibrate the business and then grow from there. The impact of such actions, this has been visible in our EBITDA numbers for 18. And so against a run rate of 300 plus crores, we had a reduction, about 21%, and we ended with 2,022 crores. 222 crores. Yeah, that's right. So the contraction of the EBITDA has certain factors that
Hello? Ladies and gentlemen, it seems we have lost the management. Kindly stay connected. Please do not disconnect your lines while we reconnect the management. Thank you. Ladies and gentlemen, apologies for the inconvenience. We have the management line connected with us. Over to you, sir.
Yeah, apologies for that. I'll just backtrack a little bit and just talk about the fact that our EBITDA numbers were impacted on account of Shalimar Bagh, as well as the regulatory pressures and the headwinds which is affecting all hospitals, not just us. And I went on to say that the management team have taken remedial action, and this is mainly around rationalization of costs, and most of these costs are structural in nature. So, in other words, these are not one-off costs which have been taken out. These are structural, and so this will sustain in the years to come. And we can talk a little bit more about that. Rajat and Yogesh will give you a flavor on the costs. So there are quite a few transformation initiatives which we've embarked upon, and we are fairly confident that we should be in a position to get to a 12 to 15% growth in revenue numbers and around 15 to 20% growth in EBITDA numbers. So I'll stop on healthcare now and move on to Max Bupa. Here we've had a good year, and there's a 27% growth in GWP. So we're at about 755 crores, and then we've got a profit of 23 crores. The significant event in Max Bupa has been the signing of a bank assurance tie-up with HDFC Bank. And as you all know, this is a very attractive opportunity. It's one of the best banks. And together with our other partners, Bank of Baroda, Federal, Standard Chartered, etc., I think, the growth which is anticipated in this business is without doubt. Concurrent with this, we are also expanding our distribution footprint by opening more newer branches and leveraging on what's called a variable agency model. And we're also focusing on a synergy plan between our life insurance business and the health insurance business. And as you know, there are huge synergy benefits which can be derived, whether it is through office space or even workforce. So that's something which the management team is working on a long-term business plan. And so there will be some amount of capital which will be infused in the company, but this is good capital. This is growth capital, and this is so with any new sale that you do, there's something called a new business strain, and so that will occur, and we obviously need to maintain solvency on that. So with this, I just want to hand over to my colleagues. I'll just start with Rajat Mehta for our healthcare business first, and he'll be joined with Yogesh, and then thereafter Rajat can hand over to Rahul Ahuja for Max Bupa, and thereafter we'll open it up for questions, and please feel free to ask, and we'll all join on that. Thank you very much.
Thank you, Mohit, and good afternoon to all of you as well. So I will just take on from where Mohit left, that really FY18 has been a year of reset for the entire sector. If you look at the last 2-3 years, several regulatory headwinds from stents to orthopedic, implant control to DPCO to minimum wages in Delhi, to the change in the EWS norms, etc. So in the last 2 or 3 years, about 150 to 160 crores of EBITDA got impacted now. We were running a very aggressive cost program for the last 2-3 years, and we did manage to take out an equivalent cost. We took out about 80 crores of personal cost, about 50 crores of indirect costs, about 40 odd crores of material costs. But unfortunately, what should have added to EBITDA, got eaten away by these regulatory impacts. Some of these will be sustained, particularly the ones which are changed in the norms for, either prices of implants or drugs or EWS. Some of them, are temporary. As Mohit said, one of the one-off incidents we faced caused that, aberration in the last quarter. However, that's behind us. The Delhi Medical Council has given us an absolutely clean chit, and hopefully the other inquiries, will close as well. So that's a little bit, flavor of what happened now. While we look at this year, as I said, and we are recalibrating, there's a very aggressive transformation journey, which is on, 2 axes really. One is to continue the aggressive cost program. So we have taken a 60 to 70 crores of cost takeout even this year, and this will continue for next few years. But we are also focusing on a few other levers which will help us improve volume specialty channels. So, how do you make the walk-in a more sharper, tool? What do we need to do on BTL or digital? Last year we had experimented with digital. We took a very modest target of generating 50 crores, of revenue. We actually ended up doing 112. And our aspiration is to, hit the 200 number this year. That's a new initiative. We had looked at up-country, expansion. So we have spokes now in Lucknow, in Meerut, Muradabad, Guwahati, Ranchi, Patna, in Srinagar, Ambala, etc. So we are continuing to do that. So focusing on the channels, how to build digital, how to deepen the up-country network, how to look at international has been a good story for us so far, 17-18% growth regularly. But how do we open more, own offices and go direct, as well? We opened the first one last year, in Kenya. Also looking at specialty, so we've done an interesting analysis basis our starting position, profitability, and market size, and we are focusing on the 4 to 5 star specialties. Oncology, which is our lead specialty, we are the largest now in North India by revenue, by number of oncologists. We are further deepening our presence by disease management groups. We are now looking at sub-segmenting neurosciences and transplant. We did add a liver transplant program, 1.5 years back, which is doing pretty well. And similarly, looking at cardiac sciences as well. So that's the specialty mix thing. How do we allocate larger share of beds to specialties which give us higher contribution per bed? Pricing, that journey will continue, and I will touch upon, maybe there's a question around the recent announcement by Delhi government of its intent to control prices. But pricing, we're looking at how do you de-risk our margins and shift the margins to value-added service provided by the hospital. Looking at optimizing platform opportunities. So when the OPD patients come to us, how do we get a larger share of wallet in terms of diagnostics and pharmacy and physiotherapy? And obviously continuing our work on the clinical, compensation models. Now this is, some initiatives on transformation, but there are some, bright spots as well. We had about 2 years back seeded several alternate models. Max at Home, already at a 28 to 30 crore exit rate at the end of 2 years with minimal, allocation of, capital. We are offering 17 service lines. There is physiotherapy at home. There's X-ray at home. There is critical care, at home. There's wound dressing. There is pharmacy at home. There's pathology at home. So we are building that line. Max Lab similarly, which is the B2B business. So we are managing about 7 hospital labs for other hospitals. We also have collection centers, about 60 plus now in NCR. And 3 or 4 outside NCR. We launched Mohali and Uttarakhand as well. That is also a very healthy rate of about 20 crore, revenue. This is the outside hospital business. And about, healthy uptick on the samples, about 20,000 samples per month as well. The third was the Onco Daycare. We were the first one set up as daycare center, about 15, chairs of in Lajpat Nagar, which is part of, South Delhi, headed by a very renowned clinician, which we hired from All India Institute of Medical Sciences. It was EBITDA break-even within 1 year, running at about 18.7% EBITDA and EBITDA of 10%. It's a leased property. And then an immigration business. So these were some alternate businesses which are doing pretty well, and now we're looking to scale them up. Lastly, I would say, look, the same management team over the last few years delivered a CAGR of about 42%, on EBITDA and a 22% on revenue. Our flagships, particularly Saket and PPG, have seen a 15 to 17% margin in the past. We've delivered that. A 6 to 7% increase in RPOP, 75% occupancy or thereabouts. So as we execute our transformation initiatives, I have absolutely no doubt that some of these, trends will start coming back in our flagships, coupled with the 900 beds we're going to put up as brownfield, which are happening only in our flagship. Bulk of it is Saket, Vaishali, and part of it is Shalimar Bagh and Mohali. So coupled with that, we will be able to see outlook of a robust trajectory, as we go forward. And while doing all this, I think we also did 2 acquisitions, which you are aware. And both the acquisitions, Max Vaishali and, Max Smart, very quickly we were able to transform both the revenue channel mix and the EBITDA. Just to give you some numbers, Max Vaishali, when we took over in July 15, was EBITDA margin negative 1.3. In March 18, the exit is 17.4. Similarly, the Max Smart, which is negative 7% in December 15, March 18 exit is 22.5% at a unit level. So, we are pretty confident as we put this transformation initiatives in place that the climb back will start. Yeah, it's going to be a reset year for us. The environment continues to be turbulent. The Delhi government 2 days back announced a draft advisory where they want to cap drug and consumable margins in the hospital. They want to allow the inpatients to buy pharmacy from outside. And there are packages and some caps they want to put at, the bill versus estimate deviations. But that's still an advisory. The industry has got together. And we are looking at how do we, make sure that our fundamental right of doing business is not impacted. There are some concerns we have on quality, particularly if you allow patients to buy pharmacy from outside, then who takes the accountability, of the outcome that shifts to the patient, which is quite odd. So there are some oddballs in that, which, the next few months we will navigate. Whatever I have said obviously does not take into account the NHPS, how that will get rolled out. The Delhi government will, take it up or not, because the Punjab government already has refused that they will not implement it. So that is obviously not part of my dialogue as yet. On the Delhi CA, there is a price increase we'll have to take. So we'll simply have to shift margins from drug and consumables to value-added services or room rent. So we think we should be able to claw back a fair bit to that. So that's been our journey and the outlook. On the other hand, if you see the investors deck, the demand is, spiking, driven by the rising entity burden, the proliferation of insurance that is happening, the medical value travel, right? It's just that we'll have to find the new normal and implement and execute rigorously to be able to climb back to our trajectory. So I'll stop here. Thank you very much, and I'll hand over to my colleague, Rahul Ahuja from Max Bupa.
Good afternoon, everyone. Thanks, Rajit, and thanks, Mohit, for, telling all the summary about the performance and opportunity in Max Bupa. As we all know, there is a lot of buoyancy in the health insurance sector, largely driven by the rising affluence and urbanization that's taking place in our country, rise in the chronic disease incidence, increasing medical costs and high out-of-pocket expenses, the internet penetration and e-commerce growth. All these things are, huge positives, for the business. And we are seeing that as a result of all of this, it's leading to, existing players in the industry making a lot of investments, both in distribution and capacity. There are a lot of new entrants who have applied to the regulator for license in health insurance business. And obviously, we keep hearing about some M&A activities that are in the pipeline as far as existing players are concerned. A few numbers. Health insurance as an industry is growing at about 22%. The B2C market, where Max Bupa is largely a B2C player, that particular segment is growing at about 24-25%. As a company, we last year grew by about 27%. If you were to look at a slightly longer term time duration, last 5 or 6 years, our top line, which is called GWP, has grown by about at a CAGR of about 30%. Our combined ratio has been steadily coming down. It's down to about 109% levels as of last March, which is March 18. Our claim ratio, which is the biggest expense side item in our P&L, has been pretty steady. In the fiscal year 17, we had ended at 57%. In the last financial year, we have improved it to about 55%, largely on account of the repricing that we did for 2 of our flagship products. So that's good news. And we keep seeing a lot of traction as far as, growth in our B2C core business is concerned. We as a business are also now looking at, few segments of opportunity in the B2B business where we've largely been absent by choice because of the irrational pricing that existed in the market. We are seeing some green shoots there and tweaking our strategy of how best can we play in certain pockets which seem to be profitable in that segment. As far as our distribution is concerned, Agency continues to be a dominant contributor to our business. It's at around 49% as of March 18. However, the share of agency has been coming down gradually given the growth in banca and alliances. As all of you would know that 18 months ago, we had added the second largest PSU bank in the country, which is Bank of Baroda, as our distributor. And I'm happy to say that in 1.5 years, we have seen a very high level of integration, both at people level as well as system level between the two organizations, which has started yielding results in the form of steady growth. The opportunity is huge because Bank of Baroda has about 5,500 branches spread across the country, and we are trying to harness that to the maximum possible. We are in there with another Sahi, and last year, amongst the two of us, I'm happy to say that we had about 58% of the health insurance business from this bank versus 42% by our competitor. As I said, there's a lot of focus on expanding distribution, and as Mr. Mohit Talwar said, we have signed a corporate agency agreement with the largest private bank in the country, which is HDFC, and we are currently in the process of stitching up the mechanics of going live with this bank, and we are very excited with this opportunity. And I think in times to come, this should give us rich dividends in the form of both growth and entry into the various segments that the bank has. As far as the growth story goes, and any industry which witnesses high growth, you need to keep your innovation right up there. And Max Bupa has always believed in delivering or innovating both at the product side and in customer service. We have launched a new product called Go Active, which is a very unique and first of its kind product, which not only gives you health insurance but also takes into account the wellness part of our customers, because the endeavor as a company, as I said, claims is our largest cost, and the endeavor should be how to ensure that our customers keep healthy and fit, so that the claims cost is always under control. So this product offers very unique features of health coaching, which is the first time introduced in the country. On innovation, we've also introduced a concept of point of care desk in various partner hospitals. This is a desk where there is a representative from the company who's there to help out our customers in times of need. We all know, that a journey to an hospital is never very pleasant. Nobody goes there with a very, in a happy mood. It's always a lot of tension when you enter a hospital. And we thought that, we should be there to help our customers. So we are expanding this particular network. It's been received very well in the 6-7 hospitals that we have started it in the last 6 months. And our customers are really appreciative of this particular initiative from the company. And at the same time, it also helps us, get some business as well, because there are our sales representatives who man this desk as well. And we have seen a lot of early success as far as productivity is concerned. So while this is a cost that we are incurring, but it's a good cost because it's self-funding in the form of business that we generate from this desk as well. A little bit more on innovation. We had launched the Anytime Health Machine, which has been viewed very favorably, especially by our banca partners. And we are in the process of deploying this not only in banks but also at a lot of public places, let's say high-end malls, which have good footfall, and places like airports, etc., are all in the pipeline. We continue with our promise of 30 minutes cashless claim processing, which is very unique and continues to be unique in the industry, and always ends up in customer delight. As far as more initiatives are concerned, continued focus on increasing distribution, HDFC being a large one, and as was said earlier in the call, on our agency, we are expanding our variable agency in Tier 2, Tier 3 cities in the country. We are leveraging on synergy with Max Life because Max Life has a huge distribution and we want to leverage it to the maximum extent possible, both as far as business is concerned and costs are concerned. That's another area where we will be investing over the course of next 12 to 18 months. That's about it for Max Bupa as a business. I will hand it back for any queries that you guys might have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. The first question is from the line of Anand Bhavnani from Samiksha Capital. Please go ahead.
Thank you for the opportunity, sir. I have a couple of requests and then a couple of questions. So the first request is on the financial statement. Sir, this quarter being the year end, we have got the consolidated numbers, but for rest of the quarters as well, because it's a holding company, standalone statements give lesser visibility. So if you could release the consolidated statement, that would be very helpful. I understand the analyst presentation has a lot of details, but financial statement would be much more helpful. And secondly, with respect to Bupa, a lot of independently listed insurance companies give quarterly filings. So if we can have that kind of filing for Bupa as well, it would be helpful. And Bupa particularly, I understand from ADA also data is available, but that data is at times not updated in time, and then it's very difficult to get hold of the numbers. So these two requests. Now my first question. You mentioned in the presentation that there's reversible changes of rupees 125 crore in EBITDA due to these new regulations. 125 crore can be reversed. Now, how long do you think would it take for us for these reversible changes to get reflected in the EBITDA margin?
Yeah, so that's an 18 to 24 month journey. Some of it will start getting visible towards H2 because it will take us 2 quarters, or H1 in FY19 to be able to put our transformation initiatives in place. So it's an 18 to 24 month journey, but some of the results will be visible in H2 this year.
Okay. And sir, with respect to the regulations that came a couple of days ago, do these regulations in any way change this reversible impact of 125 crore, either increase it or decrease it, or ballpark it remains the same?
No, of course, there'll be a sharp increase if it goes through the way it is today, though we think there are several issues in terms of an appropriate legal framework not being adopted because the remit of controlling drug and consumable prices lies with the NPPA, and the states don't have authority over that. That's one. Secondly, some of the regulations, as I said earlier, are impinging on patient quality. So if you allow the patients to, buy pharmacy from outside, even the inpatients, then whose accountability is on the effectiveness and the efficacy of the drugs being purchased. So there are some portions of it which are a regulatory framework issue, some are not implementable. So we'll see in which final shape and form after we had the dialogue with the government and they have invited comments now, it will come out. But obviously it will be a negative impact. Some of it we'll be able to recoup by, looking at some appropriate pricing actions. Because currently, as you know, in the overall package, we make a loss on infrastructure, on room, on OT, etc. And those margins will have to shift to value-added services. But that picture will come clear in the next 2 or 3 months.
Okay. And so lastly, our presentation mentioned BAU growth of 102 crore for the entire year. If you can elaborate on this, and what does this BAU stand for?
Yeah. So Anand, basically BAU growth is that, you typically grow the revenues by, through the pricing action every year, and you try and, recoup the EBITDA. So this BAU growth means that we will have additional revenues, which will, and the additional revenue will have a flow through in the EBITDA. So it is, if the business is as usual, then you have a revenue growth of, 8 to 9%, and then that there's a EBITDA flow through of that. That's what the BAU number is all about.
Okay, so would this be the X of any new bed additions? It's on the same...
That's right.
Okay, sir. I'll come back in a few for additional questions.
Thank you. The next question is on the line of Hitesh Mahida from HDFC Life. Please go ahead.
Yeah, sir. Sir, we did almost 72% occupancy in Q4, and opposite of that, we did only 5% margins. Now, I don't know, I mean, if we have to get to 15% margins, what should be the occupancy level we should operate? I don't think any hospital can operate at more than 75 to 80% occupancy.
So, 2 or 3 comments. One, the hospital can operate at a 82 to 85% midnight occupancy. That's one. Possible to do so. Secondly, there's a fundamental reset of channel and specialty mix that we'll have to undertake, including some, pricing actions. So Q4 was an aberration, as I said earlier, both in terms of regulatory changes and the brand impact that we had, and therefore the margins look what they are, and some recalibration we had to do on some policies that we had to implement to take care of the future. But it is possible to dial up the occupancy to about 82, 83 and change the channel mix and pricing so the margins start looking healthy.
So, sir, if so maybe from Q1 onwards, will we see at least double-digit margins going ahead, or it will take some time?
Before we get to Q1, I think what's important for you to understand is that the margins and all which you see in the last quarter are not the normal margins. While you see the occupancy, because there are a lot of reversible impacts in performance, which we have spoken about, which have come and actually in some sense impacted our Q4. And we expect that sort of impact will continue in this quarter as well. I think the recovery will start from Q2 and onwards. But I think so there are 2 parts. So one is there's a sustained impact in performance. Now the sustained impact in performance has been washed away through cost, and there are more cost initiatives which are planned next year, and obviously as those get taken up, you will see improvement in margin. And the second is your reversible impact, which you will start seeing the reversal from Q2 onwards. And the transformation journey which Rajat spoke about, you will see some of that playing in our performance going forward.
And some of the things like average length of stay has also gone up, I think, YOY.
Yeah, it's again to do with the recalibration. So, for example, we, when we were recalibrating, we in some sense, opened of the institutional channel completely. Now, as we speak today, what we are doing is we are exiting few channels on the institutional channel to bring back our mix. So, the ALOS is generally tends to be high in the institutional business, and the margin tends to be lower, which is why you see the margin you see. But as part of the transformation journey, the channel mix will shift. There's a strategy to shift the channel mix in favor of more and more a profitable institutional business, and B, reduce the concentration in that business itself, and increase the contribution from international walk-in and third-party channel. So the margins which you see in Q4 or you may see in Q1 are actually not the margins which business will track to as we move forward. We will be, tracking to more like a 300 crore EBITDA when we close the year. Those are the margins to look at.
So, sir, what will be our margin guidance for FY19?
Well, see, we don't want to be sort of specific on the 19 numbers and all, but like I said, as you progress forward with your transformation agenda, and our revenues are about, say, 2,600 crores, Mohit spoke about. So now really, if I'm tracking to 300 crore EBITDA, we are back at the, 11% margins, in some sense.
So, but we are sort of confident that we'll deliver the 300 crore EBITDA in FY19.
I mean, that's the transformation journey. That's the exit rate.
Okay. That's the exit, so 75 crore by Q4.
Yeah.
Understood. And, sir, on the CAPEX front, so considering that macros and are pretty much not in favor of the business, so are we going to slow down on the CAPEX front, or will we continue with the...
So now there are two types of capex. One is obviously the routine capex, which is typically 2.5-3% of the top line, which given the circumstances we have scaled back. For example, last year we spent roughly around 130 crores, capex plan, and this year we actually scaled it down to 75 crores kind of a number. So there's obviously a bit scale down happening on the routine capex side. On the project capex, some of it is committed already. So for example, we have to buy a share from, Modi for the other part. And also there is some capex which is into the addition of beds. So that if you have to really, that we are, at a very high occupancy levels of the existing beds. So we have to add capacity. So our plan is to really, while build the structures that are there, civil structures there, and finish that, part slowly as we need the beds. So obviously there'll be some kind of pullback, but it will not be a great, I would say, change from what the plan was.
Okay. So what will the capex guidance for FY19?
So there's a Modi state. I'm saying if we leave the Modi state side, so it'll be in the vicinity of 300 crores, which is both for routine as well as the new bed additions.
See, I think on the capex front, there is a lot of work happening around to see how we can, in some sense, bring down the capex itself on a per bed basis. So that's also one of the initiatives as part of the transformation agenda. Now, those savings will flow through to, in some sense, reduction in capex and all of that.
Okay. And so are we looking at any other state other than Delhi? Because considering their, whatever happening with the government, are we looking at some other state to get into, or we stick with the southern part of India?
So there are three answers to that question. One is that, as I said earlier, we are opening more and more outposts or OPD centers across different parts of the country to get more drainage. We already have 17 or 18 already opened up at Jammu, Srinagar, Guwahati, Ranchi, Patna, Muradabad, Lucknow, Kanpur, Allahabad, Varanasi, etc. That's one. Secondly, we are examining O&M. So we have looked at a very interesting O&M in Ludhiana, which will get finalized in the next 30 days or so, where you give your management expertise and operate a few specialities with very, very minimal capex investments. And we're looking at that in domestic as well as international, both the opportunities, right? Having said that, most of our bed build-out is in brownfields, which is Saket, Mohali, Shalimar Bagh, and Vaishali. So at this point of time, will we go and open a new hospital in anything outside North India? Unlikely.
Okay. And lastly, on the Shalimar Bagh front, sir, have things normalized, and are we back at a reasonably good top-line run rate?
Absolutely. I think we opened within 12 days, and in the month of January, February, we got back to a very healthy top line. Of course, the mix has gone a little adverse, right, because we had to open up a lot more institutional to cover up the gap, and that will get controlled. So we are back on the revenue trajectory, and as I said, the Delhi Medical Council has given us an absolute clean chit. The report is out now, and they have said absolutely exonerated all our clinicians.
Okay, sir. Thank you and all the best.
Welcome.
Thank you. The next question is from the line of Charulata Gaidani from Dalal & Broacha. Please go ahead.
Yeah, my question pertains to what is the kind of increase in beds that you anticipate, and what are the occupancy levels going forward?
Yeah. So I think there's a slide 23 in the deck. So that shows the capacity addition. So we are adding 106 beds in this year. I think that will be operational by Q3. This is in Vaishali Hospital. And then we have, application being put in for expansion of Mohali Hospital, where we're going to add another 85 beds. So I think if you refer to the slide 23, you will have all the details there.
Okay. So you expect you expect the healthcare business to grow from second half of FY19?
That's right.
Okay. And what about profitability?
So as I said, the first 2 quarters, the readjustment quarter, while we will grow, the growth might be muted, but starting H2, you'll start seeing the impact of the transformation initiatives, and the exit rate, as I said, is around 300 crores EBITDA.
Okay. Okay. And what kind of a growth you expect in health insurance?
Rahul, you want to take that? Rahul?
Yeah, I'm sorry, sir. Rahul is not connected.
Oh, okay, no worries. So I'll take that. I'll take that one. See, with the, with a lot of initiatives which Rahul spoke about in terms of, improving productivity of our various bank partners, the new win around HDFC Bank and, then the whole initiative around growing through Max Life offices and, variable agency model and opening some new offices, etc. The new sales growth rate will be very robust, maybe, like upwards of 30-35%. The overall GWP growth will be in the same ballpark of say 20-25% because of the renewal rate being where it is.
Okay. Fine. I'll join back with you.
Thank you.
Hello?
Yeah, Rahul, you there?
Yeah, I'm back.
Okay, good.
So, as far as growth in the health insurance business is concerned, as I said earlier, last year we grew at about 27%. In this current financial year, our new business is projected to grow in early to mid-30s, given that we are investing in distribution both on the banker side and agency.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, team. Good afternoon. I have 3 questions. First question is on the EBITDA bridge that we have given on the Max Healthcare. And if you see the bridge, we have sustained impact of 110 crore for the full year and 125 crore for the reversible impact. And, we have some additional growth coming in from BAU and cost reduction. So, 222 crore reflects the cost absorbed on sustained impact from regulatory interventions and the reversible impact. So, is that impression correct?
Yeah, that's right.
Yeah. So, my question is, these are the costs which are already absorbed in the 222 crore, and we are targeting slightly better top-line growth this year. So, our BAU growth that we are looking at will be, upward of 102 crore that we got, last year. And we are also planning a cost reduction of around 64 crore. So, kind of numbers that we are talking about in terms of EBITDA growth this year seems to be a tad lower than what this mathematics suggests. So, what am I missing here?
You're missing the BAU growth that happens. So
Okay.
there's inflation. There is
What we are missing is the annualized impact of the sustained hit to the EBITDA, because what you see here as a 29 crore, if I remember correctly, 110, is only part of it. See, there is about 75 crores included in here, which is on account of the stent and ortho price caps and all of that, which we have washed through the 75 crore cost takeout. But there's another 30 crore sustained impact, which is something which we have yet to act on. Now that 30 crore actually on an incremental basis next year is another 84 crores.
Okay.
So really your cost takeout of 64 crores will in some sense wash that 84 crores impact.
Got the point. Yeah, got the point. Okay. So basically the sustained impact is probably going to be slightly larger on annualized basis going forward also. So the incremental part will flow through.
Absolutely. And therefore that annualized impact of that we will take out through the costs.
Got it. Yeah, thanks. My next question is on the, Max Bupa. If I remember correctly, we were targeting, break even in FY19. And, the number seems to suggest that, probably we are probably ahead of the schedule. And, we are kind of also now venturing out and kind of doing the distribution through HDFC going forward. So is this profitability sustainable, or is there any one-off this year which will take us back to the kind of break-even level, or there is a hockey stick which will play out from FY19, FY20?
Jatin, do you want to take that or should I reply?
Why don't you go ahead?
Rahul, go ahead and I'll supplement after that.
As far as the profitability is concerned, yes, your understanding is right that last year we were profitable. However, we have to keep in mind that this profitability was largely supported by the reinsurance arrangement that we did. As far as, FY19 is concerned, as I had said that, the company is looking at expanding its distribution in a big way. And any new distribution that you build up has a lot of strain as far as new business cost is concerned. So it will surely have an impact on our break-even timelines. However, since these are very large steps that we are taking in expanding our distributions, currently for the next quarter or two, these will be in the pilot stage. So we'll see how the integration happens, how we ramp up, what kind of uplift we get. And then we'll be in a better position to comment on what kind of impact it will have on the break-even.
Okay. So the break-even timeline will shift to FY20, looks like from your comment. Is that understanding correct?
Can I come in here? This is Mohit Talwar.
Yeah.
See, the guidance which was given earlier, at that point in time, it was based on, your existing arrangements which you had with a few banks as well as the agency channel.
Right.
Now, in this is a very peculiar business. The more you grow, right, you have to put in capital. That's the nature of the beast, because almost half of that capital goes towards solvency, and so that's really good capital. Now, the other day we go and get HDFC Bank as a new partner. Now the question is, should we take that arrangement and make a success of it, or should we say no because of a guidance which we had given earlier? So I think the collective decision is to actually go for good business, and you don't get a better bank than that. And so the moment, you have alliances such as this, obviously, that's going to have an impact in terms of capital. It will have an impact, a positive impact in terms of growth, as well as a positive impact in terms of all your other ratios, because you've got the growth coming in. But no doubt, the break-even will be pushed out on account of some of these initiatives which were not foreseen earlier. I hope that kind of makes it clear.
Yeah, sure. That's very clear now. And my last question is on Antara. I think we mentioned that, first asset-light growth kind of kick-started with the first project in Noida. So if you can shed a bit more light on that, and, what is the timeline and what is the kind of structure that we are looking at?
Okay, sure. So, there's a real estate developer in NCR which is mostly active in Noida by name of Logic. So this is a plot of land which they own, wherein they will be responsible for building the units for Antara there. Antara's responsibility will be to sell those units under its own brand, for which it will collect a fee which will be 17% of the revenue from the sales. And then Antara's responsibility will also be to operate that community, which will get it some, which will Antara will earn a monthly charges, in exchange of the services which they will provide in that community. So that's the model. There isn't too much investment which is required from our side. So that's why it's asset light. And the investment is mostly on the developer and balance through the pre-sales.
Okay. So typically these are 3 or 4 year payback kind of projects, or significantly better?
Yeah, I'd say that, given now RERA and everything else, you can't implement the project in one go in today's world. So therefore, you have to do it in phases. And if you do it in phases, then the project timeline would be more like 7 years to my mind than 3-4 years.
Okay.
But from a payback for us, it's 17% of revenue. So long as we say sell about, I'd say, the first phase itself, which is 3 to 4 years from now, we would have recovered our capital.
Okay. Got it. Yes, thanks. That's it from my side. All the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to 2 per participant. If time permits, you may join back to the question queue for any follow-ups. Thank you. We have the next question from the line of Deepika Gupta from First Voyager. Please go ahead.
Hi, this is Hardik here. I had 3 questions. Firstly, when you're talking about this transformation initiative that you're taking or readjustment, can you just elaborate a bit more on what exactly, is the recalibration that you've been doing?
So a couple of things I said, both on the revenue and the margin axis. It is on both. So, for example, on the channel mix, how do we increase the proportion of international business, walk-in and TP, and reduce the dependency on institutional? On institutional, maybe let go of a few accounts. We're already, exiting one of the accounts, for example, and therefore focus on PSU Navratnas, which are more profitable. That's one example. On specialty mix, allocating, beds to specialties will generate a healthier contribution per bed. We've done the analysis, and therefore focusing on neurosciences, higher-end cardiac sciences, on oncology, on transplants is the second example. Third is looking at pricing, and besides looking at opportunities where we could push the pricing, also looking at how do you shift the margins from drug consumables to value-added services. Right? Then looking at opportunities or platforms of people who come from for OPDs to us, sometimes do end up taking pharmacy or diagnostics from outside. So how do you increase that conversion rate? How do you increase the conversion rate of orthopedic patients to physiotherapy? Another example of platform opportunity. Third is, the alternate models which have done very well for us. How do you accelerate their growth? It might require some investments, but there the return on capital is far better. And continuing our aggressive cost takeout program, particularly focusing on personal costs, both through rationalization, automation, and reengineering of processes, setting up a shared services center, for example. On doctor compensation, rethinking doctor models. We're already experimenting with a few contribution share models, which align the organization and the doctor's interests, very quickly. Those are some of the examples of what we are working on.
Okay, got it. The other question I have, if I just look at the Q4 numbers, right, on the top line, you still managed to do about a 3% growth, but it's really the expenses which grew, total expenses, if I take all included, it's grown by about 12% year on year. And this is in spite of the cost takeout that you talk about. So I just want to understand, while we talk about all these issues that happen with Shalimar Bagh and regulation, the absolute increase in cost seems quite high. So what is the reason for that?
Yeah, so I'll hand over to Yogesh, our CFO. I'll just give some top comments. One is the minimum wages impact that came. Second, is some provisions we had to make for ESOPs for our key talent, which happened, and some of was the recalibration that we had to do on account of some adjustments on the statutory side. But Yogesh, over to you.
Yeah, so basically, I think the expense trajectory went up in Q4 mainly because of minimum wage and and ESOP, which is actually reflected in the HR cost. So and also I think if you see the difference between the gross revenue and net revenue, you will see that this quarter was a sharp increase in that differential, which is because of EWS. EWS has a double whammy in terms of the impact on P&L. One is that it takes away the productive beds. So we, in a way, earlier we were able to use those beds. Now these beds are allocated in the sense that these can't be used for the other patients. So sometimes you have to even refuse the patients and you allocate these beds. And other is, the negative impact of that in terms of the material cost and other servicing costs. For example, all these patients, we have to serve them food. There's a material cost which used for these patients. So it's a double whammy in the sense that the revenue came down, and also we had extra costs coming in the P&L because of the EWS patient going up. You would have seen, in the quarter to quarter, there's a 117% increase in the EWS, costs. So I think that's the major impact which actually traveled down. You find that, typically our material cost used to be less than 25%, but this quarter it's gone up to 25.7%, mainly because of this whole EWS thing, and it actually had an impact on the overall P&L. So I think as we stand today, I think Rajit already mentioned, we have to reset the channel mix. We are working very aggressively on cost side, there are 3-4 projects which are touching on the manpower cost side. And we do think that, by Q2 of this year, we should be able to bring these cost increases, quite in control.
Thank you.
Also, I'll just add to Yogesh is that the new SBUs that we have, which I said Max at Home, Max Lab, etc., there we continue to hire people because that business we need to grow. Some of the hiring, also is a cost that gets reflected.
So I think what happens is that while your revenue includes the sort of the revenue from some of these SBUs, but because they are all in growth phase, so net they are at break even. So in some sense, your margin gets diluted because of those hirings as well.
Thank you. The next question is from the line of Deepak Malhotra from ETG Consultancy. Please go ahead.
Yeah, hi. My first question is a pickup from the last question, which is on the personal cost and the HO cost. While you basically are mentioning that this is kind of looks like one-off, but from what you just answered now, it doesn't look like there's going to be actually one-off. I mean, this could continue.
So I'm sorry if you gave the impression it's a one-off. Minimum wages is a regulation, that the Delhi government passed, so that's a permanent increase in cost. The ESOP provisions obviously, is a one-off in one sense. It'll get normalized because we had to, we allotted them and therefore the provisions came in the last quarter. EWS is a sustained impact because that's a change in regulations already happened. SBUs will tend to taper off because once we made the investment, therefore the throughput on the other side of revenue and therefore better margin. So that will, taper off.
How much is the ESOP part?
What part?
ESOP.
It's roughly a 6 crore kind of.
Sorry?
6 crore.
Okay. Now, when you basically, you already answered this question again in terms of the run rate for the EBITDA margin. Now, given the challenging conditions which we are having, with both the central and the state government especially, making and creating new regulatory hurdles. And if we look at the latest one, that is even more dangerous. Things like, if you have the first surgery, you anyway get a discount, and then if you have a second surgery, then you have to have a 50% discount. If you get admitted and unfortunately the patient dies within the first 6 hours, then there is a 50% waiver and things like that. So when you look at that and combine it with in terms of that you are concentrated largely in Delhi, and even though you did mention about 3 initiatives in terms of trying to open new centers outside Delhi or trying to have an O&M facility in Ludhiana or trying to go for some brownfield expansion, which will anyway take time. It does kind of makes it very challenging to have a run rate of 75 crores EBITDA, which you mentioned. Q4 anyway you mentioned it's not going to happen. So this looks really quite challenging battle to come back.
So we lost part of that question. Actually, we were, off the air, but if I get the gist of what you're asking, and I'll reiterate. Yeah, it is challenging, no denying that. But this very team, which has been fortunately very stable for the last 3 to 4 years, has delivered very healthy growth rates. By the way, regulations were, coming. They appear to have come in a cluster right now, but actually they've been coming for the last 3 years. There's been, DPCO action every year. So we have, had those headwinds even in the past. So I think our initiatives are lined up pretty nicely. As I said, it takes time to execute given the nature of our business. On the Delhi CA Act, as I said, it's currently advisory out, for public opinion. We are not too sure the legal framework that exists for the state to take over what is a remit given to the NPPA, which is a national, body. Just to give you an example, the Delhi Pathology Association is in the court over the rates that were capped by Delhi government on dengue and chikungunya tests, and the court has sent a very scathing reply back to the Delhi government saying you cannot look at process costs, the diagnostics are processes, not commodities. And they have asked the question of Delhi government, why should you not refund the loss that happened to the private players? So I'm just giving you an example of which way this could go. So be that as it may be, we have also a plan B. In case that does come through, there is, a plan to look at how to shift margins to where we can, how to take sensible price increases, how to look at packages combining drugs and consumables. So that plan we already have. It will impact surely, but to a large extent we should be able to, recover it as well.
And to your point about, why don't we kind of de-risk Delhi and go to other states? I'm not too sure about a strategy such as this, because don't forget that you're getting into an election year, and I wouldn't be surprised if you have CA coming into other states as well. So, this is something which I think all hospital companies have to be staring at, and they have to be proactive and nimble enough to manage, to try and navigate through this scenario. And I think we are in good shape to do that. Hello.
Thank you. The next question is from the line of Jigar Shroff from Financial Research Tech Limited. Please go ahead.
Yeah, thanks for taking our question. So two questions. So any further, have you been able to assess any impact on the Modi Care health initiative, which has been announced by the government? That is one. And second, any updates? There are reports appearing in the media regarding stake sale by the joint venture partner in the healthcare division, sir.
The second one first, which is on Life Healthcare. Now, in the media, you would have read that, Max is looking at that stake. So, but at this point in time, there is a discussion on, and really, to be transparent about it, basically the discussions are around valuations. And
okay.
At this, I'll kind of leave it at that. They are in no tearing hurry to get out of India. They will at a price. And also there is a process which they initiated through Barclays. And, so on that one, I'm not very sure as to where matters lie, but looks like they've got a few bids, which also they are looking at.
Okay.
Those numbers are, I'm not privy to it.
I see. Okay.
On Modi Care,
on the question of Modi Care, as I said, the framework is yet to be announced fully. We are in dialogue with the government. They have taken out a place for, rate. As we understand, the focus is on tier 2, tier 3 and rural, and they want to start the Ayushman Kendra, which is the primary care where we don't have a play. At this point of time, they are not looking at mandating this. Also, there's a fair bit of clarification because you have institutional patients, we have TPA patients, GIPSA patients, all of them are on different rates and discounts.
Okay.
We have an economically weaker section which we treat free of cost. So this Modi Care will come exactly for which target segment and will sit on top of what is not clear. So difficult to comment without clarity.
Okay. Just one more clarification. Maybe I could have missed it. Did you give a revenue guidance for Max Healthcare for FY19 and the EBITDA guidance?
No.
We said on a run rate basis.
Hello, sir. Are you there online? Ladies and gentlemen, it seems the line for the management have disconnected. Please stay connected while we reconnect the management.
You in between.
I'm sorry. Yeah. Please go ahead, sir.
So as Jatin was saying that the only thing we said was that the exit rate for this year looks like about 300 crores of EBITDA at a run rate basis. That's the only guidance we gave.
Thank you. The next question is from the line of Manan Gandhi from Enrich Consulting. Please go ahead.
Yeah, sir, can you just give me a ballpark figure of what is the exact number for Antra Senior Living that we garnered this year in FY18?
What number?
Exact number meaning?
No, you have mentioned that total number of units that we have sold, but I'm talking in terms of value, sales value.
Oh, sales value will be about 300 crore.
Okay, and we have earlier infused 500 crore, and right now we have infused another 88 crore in Q4. That's for that NCR project or for another capex we are doing at another land that we have at Dehradun only?
No, so the investment is essentially change in capital structure of Antara. It's not fresh money. Most of it is not fresh capital which we have invested.
Okay, and sir, just last question. Are we planning any capex at Dehradun? Because as far as I remember, we had 20 acres of land and we had just developed at one part of a road.
No further capex in Dehradun because we have now moved from an asset heavy model to an asset light model, and to that extent, in between, we actually monetize the other parcel of land. Because now we are very clear that the growth for Antara has to be on an asset light, in the asset light manner, and there are a lot of developers who are currently under significant stress, and are finding it difficult to, sort of churn their assets and all of that. So, if a brand such as ours, which is very powerful and very well regarded in this part of the country, actually joins them and helps them to create a product which can generate a demand even in a bad environment. For example, even in Dehradun, market like Dehradun, and despite the Antara's previous project being, in some sense, a high-end project, we've been able to sell 2 units a month, whereas, most of the developers, including DLF, have struggled to sell 2 units a month in, NCR market. So now, and the project in Noida is more of a mid-segment product, and it compares very well, with the prices of the next door units by any other developer. So to that extent, this is a far better strategy from an Antara's perspective, and there's a value add even to the developer because he can churn his inventory much faster.
Can you just give a ballpark figure for FY19 for Andhra EV?
FY19 for what? Investment?
No. I am just asking you revenue guidance.
Revenue guidance. So we sell, you can take it up. We've been selling about 1.5 to 2 units a month. So that's what we would sell this year as well.
Thank you.
This excludes the Noida project. That will be an add-on. The sales will get launched in October. There, the thing is that, there's a target of 50 units in first year, given the fact that it's like a Me Too project versus a premium positioning type project. So there the sales assumptions are a tad higher than the Dehradun project.
Thank you. The next question is from the line of Anand Bhavnani from Samiksha Capital. Please go ahead.
Thank you for the opportunity. Sir, with respect to Max Cooper, you mentioned you might have to raise additional capital. Can you give us some understanding of how much could be that amount?
It's a little difficult to give any guidance on that at this point in time because, the team, they're assessing what sort of manpower deployment will be there for HDFC Bank. We are piloting some of the things on the agency side. So, for that, you'll need some clarity. I realize that, but we'll have to wait a month or two for that.
Okay. And sir, is there any scope for further stake dilution in favor of Cooper?
No, they cannot be because there's a sectoral cap, so they can't go beyond 49. And we don't have any plans right now of reducing our stake.
Okay. And sir, lastly, in case of hospitals, we have mentioned that our average number of operational beds is 2,372 and reported number of beds is 2,570. So it's a difference of around 198. If you can reconcile the reason for the difference.
Yeah, Sonam, there's a hospital, in Bathinda where we have. where we have the capacity is around 200 beds, and we opened roughly, 95 beds type. So there's a capacity available there. At that hospital, as you know, is barely break even. So it's a hospital where the ramp up is much lower than what we expected, what we built it for. So that's one major difference. And then there are always some beds which we shut down for revamping, etc. So that's the typical difference that you'll find there. So major is the Max Batinda.
Thank you. Here's the next question from the line of Rishabh Shah from Samiksha Capital. Please go ahead.
Yeah, hi, sir. Just on clarification, mentioned in the presentation the difference between gross revenue and net revenue. Is it entirely due to the EWS, or there is some element added to it?
No, so there can be three things which can come in the difference. One is the management discount, which also has gone up, in the Qtr4 we found. There's a lot of activism on the patient side, and they were not paying their bills, so we have to give more discounts on that side. And second is the EWS. Third is the unbilled revenue adjustment that we do from the gross revenue to reach the net revenue number. So these are the three I would say elements which actually define the difference between the net revenue and the gross revenue.
Okay. And second thing, the target what you have set for bed addition, are we online, or there can be some divergence?
Bed addition.
No, I think the project is underway. So as I mentioned, the Vaishali project is underway, and for Mohali project, which is FY20, we are waiting for the approval from Punjab government. So the 106 will be operational in Qtr3. And as we speak, it's the MEP work which is going on there at the project site.
Thank you. Please follow-up question from the line of Charulata Gaidni from Dalal & Broacha. Please go ahead.
Yeah, well, I wanted to know how many are the EWS beds in normal course in your total network?
So the hospitals which have taken subsidized land, which is 4 in our case, which is Max Saket East Block, Max Smart, Max Paddan and Shalimar Bagh. The obligation as defined by the government is 10% of IPD beds and 25% of OPD is for EWS, and we are compliant in all the locations.
10% of IPD and
25% of OPD.
Okay. And my second question pertains to, you mentioned that the company wants to shift the mix to more specialized services. What is the current revenue contribution from specialized services?
So I was talking about tertiary care services, and there are 5 to 6 specialties we focus on, which was, oncology, neurosciences, transplants, cardiac, orthopedics, and bariatric surgery, diabetology. I think currently it's a 54-55%, kind of mix, and we want to dial it up to about 60% or so as we go forward.
So it's available on slide 21, the present share of the various mix.
Thank you. We have the follow-up question from the line of Deepika Gupta from First Voyager. Please go ahead.
This is Hardik again. Just 2 more questions. One was, I just want to understand how the shift towards institutional business, why does that impact your average length of stay? What is it that changes the length of stay?
So Hardik, typically the mix of the institutional business is more towards medical patients, and a lot of them land up in ICU, and that's where the stay goes high. Typically, for example, if you take cardiac surgery, we will, in a cash situation, we will discharge the patient on the 6th or 7th day, but the package for the PSU is for 12 days. So the patient tends to stay longer when it's PSU patient because somebody else is paying, and also because of the fact that the package days is higher, and it can be 30 to 40% higher than the normal package days that we generally have for the PSU patients.
Okay, got it. And my second question was on the capex front. I think you mentioned 300 crore for FY19, but Isn't there like another, there's a 375 crore payment due, right, for the Saket acquisition?
That's separate.
Yeah, so this is basically on the routine CapEx, which is, as I said, 75 crores this year, and plus the project which is underway, and also some, side on the Shalimar Bagh and some parking we have to make in Parpatan, etc. So this 300 crores is not including the Modi part of it. So
and the Modi part is 375, so totally you're talking about 675 crore?
No, 375 plus there's an increase of 12%, so that will be roughly around 500 crores, if you do it, let's say by end of September.
Okay. So 500 and 300.
Yeah.
800 crore is going to be your total capex related or acquisition related expenses.
Yeah, but the Modi side is also dependent on us getting approval. So it is the obligation of that party to get all the approvals for build out, which have not come in as yet. So, but that comes through, you're right, it will be about 800.
Okay. All right. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference back to Mr. Mohit Talwar for closing comments. Thank you, and over to you, sir.
Thank you very much for taking time off to be on the call. Wish you all the very best. Have a great day.